Will you try refreshing?
Yeah, let me try that.
Oh, it's because I have to press go live.
Yeah, I was gonna say, I remember there was one extra step yesterday, so. There we go.
Okay. Okay. Okay, cool. That's we got Tommy, my coworker, in the chat, so that's perfect. All right. Um, just getting ready to go here for anyone who's already joined. I think it's just you. Are you joined as a viewer, uh, Justin?
I was. I just closed the window, but yeah, I
Okay,
was
cool.
watching it.
So I think we have like one other viewer besides Tommy right now. All right,
Nice.
cool. All right, I think we're all set. Cool. All right. All right. I am going to um, retweet about how we're live
Okay.
or about how we're going live. All right. Cool, cool. Um, Tweeted it out. Hopefully, we'll have some people jump in here in the next couple of minutes.
Cool.
Cool, cool, cool. All right, we got a couple people in. Raph. Hey, Rika, thanks for joining. Good to see you. Um, Raph, I don't know why you need YouTube Premium to watch a live stream, but I'm really glad that you were able to make that investment in your life. That's good. Um, all right. Well, thanks everyone for coming. We're gonna get started. I am Prishan on Twitter. I'm head of marketing at Tally. I'm also gonna be staffing the chat. I'll be Tally in the chat, but just so you know, that's me. That's me in there shit posting. Um, and yeah, what we're gonna do here is we're gonna have Justin, who's my partner on the stream. He is from 1KX. What's your role specifically at 1KX, Justin?
I'm a research analyst, so I primarily cover like more emerging verticals in Web3, so things like Web music and digital fashion, AI on chain, like a lot of the more out there stuff. But I also help a ton with the governance and helping with like DAOs in their initial stages, essentially. Before joining 1X, I had worked full time for DAOs for about a year, mainly in like treasury management functions.
Awesome. So Justin is the big brain here, and he is going to walk us through like a really helpful and thorough guide to DAO Treasury management. Hopefully, your DAO is still alive and thriving in this bear market, but the information that Justin's going to drop for us is going to make sure that continues. Rika, Justin is a research analyst at 1KX. And if we have more quality issues, definitely post in the chat and let us know. So yeah, with that, yeah, I'll give it away to Justin. Anytime you have a question, just post it in the chat. We want as many questions as possible. Hopefully, this will be super interactive. And I will grab your question and pose it to Justin, and I'll also be asking questions myself as we go along, just to get a good back and forth going. So yeah, let's rock. Justin, you want to go ahead and share your screen and take us away?
Okay.
Cool. Yeah. So some of you all like have probably noticed, this topic of treasury management and Monet supply is in the chat. Now I'm really nervous because Monet supply is like a treasury management OG, and I want to make sure we are up to standard. But yeah, thanks for joining. Thanks for joining, Monet. Yeah, this has obviously been a hot topic. DAO sustainability is obviously like a big challenge and opportunity that we're all trying to solve. And so like figuring out what to do with the money you got, and how to think about that is obviously super important. So yeah, looking forward to this.
Cool. My screen?
Yeah, I can see it on my end. So we should be looking good.
All right, I guess we'll dive into it here. So, like was being said, we're just trying to help out with just some of the basics of DAO treasury management. Maybe starting with one of the more important topics, I would say, which is budgeting and financial reporting. So why do DAOs need accounting? Right now, I think when you look at the space, there's a variety of DAOs that do really good at trying to be as transparent and open on the accounting front as possible. There's still a lot of room to, though. A lot of DAOs still don't have financial reporting, which is fine. I mean, like we get it that because everything's on chain, it's like easily traceable and trackable, but a lot of times these organizational structures kind of get unwieldy, and it becomes harder and harder for both governance contributors and just like outside investors to kind of understand the current status of a DAO. So typically the objective of reporting is just to kind of provide financial information that's useful to all users in making decisions about how to. And DAOs have a variety of capital needs. Like there's things like grants, there's human capital costs for contributors, if there's a team, or even contractors if you're working with things like service DAOs or any out contractor on that end. And then some expenses too, right? Like suppliers, technical infrastructure, marketing. So there's a variety of these direct capital needs. And then what we should be doing as DAO contributors is trying to understand those direct capital needs, forecast them out, make sure that we have liquidity, no funding issues in the future. And we'll get into later about some of those ways of ensuring there's liquidity and fundraising and things like that. But yeah, for now, just kind of want to hit on the budgeting is like very important. There's different requirements for different DAOs at different stages of their life cycles, and to kind of come up with where and how best to allocate resources at the end with unsustainable spending or liquidity crisis in the end. So when looking at these reports as well, something to consider is operating currencies. So this is standard when you're dealing with like foreign international businesses, where you have to kind of decide which currency the majority of your operations is taking place in, and use that for reporting purposes. So one suggestion I have for a lot of DAOs here is not to necessarily use your own native token values, although ETH values do make sense in some rare instances. But more often than not, your operating currency should probably be stablecoin USD. And the reason for that is you need a consistent currency to pay contributors in. So if you're doing an outflow of $10,000 a month to a specific contributor, you're going to have to pay that regardless of fluctuations in the native token or in ETH prices. And that can lead to, very inefficient. It becomes rather difficult. You end up paying out a lot in a native token. It's just easier to kind of see across the board once you reprice those outflows back into stable values. And native DAO tokens themselves aren't really designed for operational budgets, just again due to that volatility and even their governance in some ways. And then revenue too into the DAO is generally not based in a native token. Usually it's an assortment of currencies. And yeah, just overall, it's much simpler when using operating currency. Hopefully that makes sense. Cool. And so types of financial reporting, there's obviously the balance sheets, which are the current holdings of the DAO. That's again being converted into that operating currency. They're typically done on monthly or quarterly streams, and they represent just a simple snapshot of holdings at a particular time. I won't bore you with all the accounting details, but I guess like real shortly, there's asset equity, where assets minus liabilities is equal to the remaining equity in the DAO. Assets are what the DAO owns or controls. Liabilities is what it owes, and then equity is just that residual interest. And a DAO's ability to pay its short-term operating needs relates directly to the concept of liquidity. Not liquidity as in how liquid your token is on an AMM, but liquidity as in the amount of cash or cash equivalent buffer any like short-term financing needs. So a liquid asset is easily converted into cash, or again, like a cash equivalent in a short period of time at a price close to fair market value. So that would be things like stablecoin equivalents, such as A tokens from Aave, for example, but anything that's easily convertible there. You can see here's Yearn's last balance sheet from Q4 of 2021. And what I wanted to talk about on this angle is just kind of like how they're breaking down these categories that differs from like a traditional business to a DAO. So cash and cash equivalents, again, is going to be stablecoins or stablecoins deposited into their Y vaults. The accounts receivable, which would typically just be like, earned but acquired revenues. In this case, it's earned but unharvested rewards related to yield farming. And that's using accrual-based accounting, which again, won't bore you with the details, but it's one of the more common accounting types to use. Inventory is a line of credit drawn specifically from decentralized lending protocols that Yearn uses to farm those idle treasury assets. Prepaid expenses are legal and infrastructure costs. Those are being amortized over 12 months. You have other short-term assets, and these are things like crypto assets earned from and held from non-stablecoin vaults, and then some of their LP positions that they're using as well, along with keeper tokens to pay keepers to do the harvesting function. And then accounts payable at service providers or their partner program expenses. They have accrued expenses, earned paid salaries or grants, and then interest payable and long-term, which is just interest payments or debt related to those lending platform loans. So you can see it kind of structures similarly to a traditional company's balance sheet, with some minor adjustments to be made for things like yield farming, collateralized debt positions, and things like that that aren't as common in traditional finance. On the income statement side, the income statement just communicates how much revenue generating during a specific period, cost it incurred to generate that amount of revenue. The basic equation is revenues expenses equals net income, which I'm sure many of you are familiar with. We don't have to go through a lot of these definitions, but maybe just to highlight a few. The cost of revenue is particularly interesting. So that's labor and material costs related to revenues. Some salaries, such like BD salaries, like salaries related to actually creating like sales or revenue flows. Yearn accounts for this by using strategist fees as a cost of revenue along with their program and cost, since that's all being incurred just to generate additional income to the DAO. Another area that's kind of different is other income and expenses. So those are expenses that are related to that are not related to running the protocol or DAO. So that in the case of Yearn's coming from yield farming gains or gas costs, capital appreciation, investment assets they hold, and again, like interest on loans. A lot of these are primarily related to what you would traditionally do in finance. I guess one other quick one is non-recurring items. So those are unusual items that occur in, and in this case, you're ahead and use like exploit related expenses and then one-time expenses related to discontinuing like services. There could, although it's arguable whether this might be an operating expense or a non-recurring item, but like costs of doing audit, for example, might be another one that would be stuck into a line item like that. And here's just a quick overview of their income statement. Maybe I'll pause there. Yeah.
Yeah, so Justin, I was just gonna jump in. Like, why is it important for a DAO and a protocol like Yearn to actually create like a net income statement like this? Or you could even apply this to just like businesses in general, right? Like, why is it important to have this type of like consistent financial reporting that tells you exactly how much money is coming through?
Yeah, I think it's like sustainability, right? Like if you have a set amount of like a liquid buffer, like you have a set amount of stable coins available to the DAO at this point in time, which that's going to be captured on something like a balance sheet. You want to ensure that, you know, if that stable position has to be decreasing over a period of time due to, you know, maybe unwieldy contributor expenses or because of gas costs related to yield farming or any of those types of things. Like you want to be able to capture where the liquidity for the DAO is going, whether that's negatively declining or positively appreciating. You want to have a good understanding of that because that will help make financial decisions related to the DAO during the governance process, right? Like a lot of DAOs vote on regular budgets, so quarterly budgets, yearly budgets, whatever it is. But without like adequate understanding of the financial health of the DAO, like you're not going to be able to make an informed decision that helps the DAO kind of survive as almost like an endowment or perpetual foundation, right? Like you want to make sure these things live on forever. So in order to do that, you have to be properly kind of accounting for some of these items.
Cool. Well, yeah, we're gonna transition from here to like dive into kind of some of these DAO specific topics, and challenges facing DAOs today as it relates to treasury management. But want to encourage you all, if you have any questions, definitely drop them in the chat, and we'll keep rolling.
Cool. So we already kind of touched on this, so I won't spend too much time here. Budgeting is very specific to DAO structure, right? Well, if you're having working groups, you're probably budgeting per working group or pod or division or however the organizational structure the DAO's practice, though, is probably to create agreed upon DAO-wide budget in consideration of those income and balance sheet reports that we're just going through, and then drill down by different group, working group, pod, division, whatever it is. And many DAOs today still are extrapolating a total budget from the sum of its parts, which leads to significant overspending and unsustainability, right? Like if you're kind of letting the parts aggregate to a total line item, like it's going to be significantly higher than if you're kind of constraining the need of the whole, right? And so there's ways to kind of understand this better, like using financial analysis, particularly like ratio analysis. We won't go into here, but financial analysis around like the operating currency allocation and runway and months will help kind of cement the total spend that you should be doing across the DAO. Then it's just a matter of like resource provisioning by group from there. Important topic, right? That's your operating currency balance. So again, if you're pricing in stablecoins, it's the number of stablecoins or the total stablecoins that you have in the DAO. Divvying that up against projected or historical monthly spend. You can also remove or apply a discount to volatile assets here as well. What Figure is doing is helping you understand if no new income came into the DAO, will the DAO survive for? And this kind of helps you plan, like, market conditions today aren't the best, to say the least. And so it becomes harder and harder to raise from like funds or like large OTC trades. Like it becomes more costly to the DAO to kind of perform those types of actions. So instead, you want to make a runway that's maybe like 2 years, let's say. That way, it kind of helps you get through a majority of this market cycle, and then you're in a good position to go out and raise or as you get close to that 2 year period. And that just again ensures longevity of the DAO overall.
So
Yeah,
Justin, I
yeah.
got like a spicy question for you.
All right, all right.
What do you think? I know you don't know the exact answer to this, but you are the research analyst at 1KX, so you might have an idea. What do you think is like the average runway for a DAO? It can't be that long, right? Especially if you're like focused mostly on stable coins. I know a lot of DAOs today don't actually have a lot of stable coins in their treasury. So like, what do you think? What do you think's the
Yeah.
average number of like months of runway for a DAO today?
Average is hard to say, but I agree with you. Like the stablecoin balances are pretty lacking across most DAOs in the space. Like most DAOs are allocated like 95 to 99% in their own native token, which we'll talk about in a minute too, why maybe you shouldn't do that. But like there's just not a lot of survivability there. And then like, the DAO Treasury becomes reflexive. Like if you're paying out contributors in your native token and your native token's, down 90% from where it was a year ago, like you're spending significantly more in absolute units and the entire treasury, right? And then, yeah, it's a vicious cycle that you can get in if you're not properly allocating to something like stable coins. And I think this is like you said, like very common throughout the space. There's not very many that did diversification. A lot of them talked about diversification kind of leading up, like during the bull market period. But yeah, there wasn't actually action that came out of those discussions, unfortunately.
Cool. Well, we're gonna get to diversification opportunities here in a sec. So thanks for jumping on that, Justin.
Yeah. And yeah, that's actually like really good segue. So the native tokens idea in the treasury. I believe it was Hasu kind of wrote a really good piece on this, which it's linked in the actual deck, which I think we'll share after this. How to think about the name. Like many DAOs report tokens in treasury as assets on their balance sheet, like their native treasury as assets, but that's probably correct. good analogy for this is traditional equity companies and authorized but and unissued shares. So there's for outstanding shares, that's float, which is what's publicly trading, plus restricted, which is whatever's vesting, and that equals like your total outstanding shares, right? And outstanding shares plus unissued shares is equal to your authorized shares. So counting unissued shares and balance for artificial inflation of assets. And you can see this like using an example like Uniswap. Like if Uniswap, which is like again one of these DAOs that has, I'm not sure the exact percentage, but I want to say it's like 95% probably in Uni tokens. Uniswap selling 2% of its treasury on an AMM would result in like an 80% decline of Uni tokens. So that value that's reported as an asset on their balance sheet isn't the real value. In other words, like as everyone says, like FDV's a meme. So when a DAO has a hack or negative event, that's like the most likely time that you're going to need capital. However, your token price also because you just have a negative event. Now you have to sell into already resolve. And yeah, just like we were saying, diversified treasury reserves are going to actually value. Good example of this again being like MakerDAO's Black Thursday event. They made some adjustments post this, but selling it with this like negative pressure is you kind of see like the reflexivity of these treasuries.
Yeah, I think our friend Monet Supply in the chat was in on that stablecoin Treasury Diversification report as well. So we got an expert among us.
Yeah. Cool. Yeah, so diversification itself then won't again bore you with all the details, but it's just kind of mixing a wide variety of investments together to reduce like the total portfolio risk. You do this by having relatively non-core assets or less than perfectly correlated assets. And correlation here just meaning a statistic that measures how move in relation to so risk assets then coins like we were just talking about are anything from operational assets, so that's holding native payment of chains in which the DAO operates within the treasury, strategic investments, so these might be DAO to DAO treasury swaps for governance or incentive alignment, purchasing assets for their strategic utility, like acquiring like V curve, to allocate rewards back to monetize liquidity for your platform. There's liquidity provisioning itself. So if you have protocol owned liquidity, you likely have DAO managed LP positions. And that's strategically to boost liquidity for your native that you're releasing as well. Capital appreciation, so any excess treasury funds might be different tokens to capture market beta or market performance. Ideally, here you're probably investment vehicles as opposed to that's like actively managing the treasury. Unfortunately, I think like so far into almost becoming like where they're kind of actively trying to manage these different positions or actively in like yield generating strategies and stuff, and it becomes too messy and it takes time away from the DAO's attention, which is probably its right. Like you're then bloating up either governance or taking risky capture like a few extra percent yield when you're potentially at risk of losing treasury. So just kind of a side note there. Other risk assets too, like fixed income like products for yield generation and derivatives if you're doing anything like that. So option strategies that are modifying risk exposure. Ideally, those are only being done for operational purposes or hedging purposes. Again, you're trying to avoid that hedge fundification. So stablecoins versus risk assets themselves, like most risk assets, but elsewhere as well, have pretty strong positive correlations that when you have extreme bouts of market volatility are approaching a coefficient of 1. So they almost move perfectly together as market volatility upticks. the addition of risk-free assets are going to help in these areas. Stablecoins, offer the greatest diversification benefits to a DAO because again, like they're mainly sitting tokens, which are highly correlated to other assets when there's huge drawdowns. So the first strategic diversification effort by a DAO organization should probably be into stablecoins. Because again, less than perfect correlations, they accomplish financial stability goals and increase short-term liquidity to help meet operational expenses.
So I have a question, Justin.
Yeah.
Like this is a lot, right? Even if you're not hedge funding your DAO and like,
Hmm.
spending all your time trying to like maximize return, it's still a lot for like most DAOs, right? You
Hmm.
know, I it's probably maybe even for Uniswap, but like perhaps more so for like DAOs that don't have billions of like notional dollars in their treasury. Um, so like I'm just curious, what are your thoughts on like how to approach this, right? It's one thing like, okay, I've attended this live stream, so like I theoretically know what to do. But like, how should most DAOs think about like actually executing on some of these things? Like, should they have a partner? Should they make sure that try to like campaign for a delegate who actually has like the expertise to execute on some of this stuff? Or how would you recommend DAOs think about executing on some of these diversification strategies, or like bringing that capability into their DAO?
Yeah, that's a good question. I think it's that are going to have financial acumen is definitely super helpful. Although a lot of times delegates are kind of dispersed across multiple DAOs, so it becomes hard from their perspective to you know manage a specific DAO, just because like they're like the super delegates are already kind of stretched pretty thin, right? I personally have always been partial to having like a dedicated team, the DAO to help on these efforts. The first stop is usually, you set up some kind of working group or pod or whatever you want to call it, but a small team of individuals that are primarily tasked with reporting, since that's kind of the first. Before doing anything else, you kind of want to understand where the DAO is today and where it's going, and from there you can start to make decisions around how should we start allocating resources more efficiently. So like financial reporting and budgeting can kind of be the first order priority for this small team. From there, you can help. They're able to kind of help transition into, okay, we spend this much on a yearly basis. Like maybe we should figure out a way to diversify that yearly amount of expected outflow into stable coins. So the stablecoin diversification question is very closely paired with the financial reporting question. So yeah, I would most commonly like recommend like having some kind of internal organizational team that dedicate resources to this, like an understanding of where the DAO is, and then start making recommendations governance on how these allocation decisions could be made, like using that quantitative assessment that they're doing.
Got it. So there's a reason you started out the stream with like financial reporting basics, right? Like having a
Yeah.
having a working group or a set of experts that are dedicated to actually understanding the financial picture, and then can start bringing in, yeah, what are our needs around diversification.
Yeah, exactly. I would always caution too, like delegate to financial experts per se. Like it's good to have like a strong background or understanding for a lot of these topics. But at the same time too, it's like good to have crypto native experience as well, just to make sure you're pairing those kind of skill sets, right? Like otherwise, you can go to if it's too crypto native, you're going to be doing like weird like experience farming, and if then they're going to be telling you to diversify like 90% of your treasury away from your native token, which is all of your inherent governance capabilities. So it's kind of like a mirroring or combining those two is the best of both worlds, I think. Cool. Okay, and then Yes. All right. So stablecoins and equivalents, like won't spend a ton of time here. I think everyone that's in DeFi probably understands this more recent events, but there's typically three types of stablecoins. There's off-chain collateralized, which is traditional currency like USD or gold. Collateral is being held by a third custodian. There's on-chain collateralized maker where you're backed by one or more cryptocurrencies on, and then the collateral is always verifiable. And then there's algorithmic stablecoins. So that's the value is dependent on algorithmically make a certain price peg. These tend to, users' expectation of purchasing power with those is what supports the combination there. So stablecoins themselves, though, they have risks as well that's specific to the crypto ecosystem. So there's the credit risk aspect, right? Like it's specific to off-chain collateralized stablecoins like USDC or USDT, where the credit risk is around the custodian and their ability to properly collateralize and manage that stablecoin. If you're not able to like easily see status of the collateral backing the stablecoin, then you're kind of entrusting that stablecoin issuer doing these things. Risk side, like that's inherent in any investment vehicle that trades freely on secondary market. Coins aren't an exception here. Volatility and price relative to the peg is the most common example of market risk. And using an example on the Black Thursday event in 2020, synthetic USD or synthetics SUSD prices dropped to around 40 cents in a single day. I think we can all hear more recent examples as well. But yeah, so market risk means that stablecoin might not always be convertible to $1, dependent on the structure of the type of stablecoin it is. Liquidity risk during periods of network congestion, or in the event like broad liquidity is removed from different AMM or provisioning protocols. And then there's legal risk, right? Like the off-chain collateralized specifically banking. And that means like they're subject to regulatory authority, so asset seizure, redemption halts, enforced AML, KYC. These things you particularly want a DAO. Those are just a handful of actions that can be taken against those custodians of those solutions. Collateralized too, like they could face regulatory scrutiny as well, whether that's taking action against like core contributors or any of the centralized like collateral assets they use underneath the hood, like USDC being held within, can be listed as well. I think broad discussion. I know Monet's here as well, so won't stick on that. There's potentially like solutions to that as well, but it's just a note on the legal of things. So all these types of risks are considered when you're deciding like which stablecoins to deploy assets into. Maybe even ideally like diversification across a variety of different stablecoins would be helpful as well. You want to limit as much of these risks as possible. Usually diversification is the thing that helps with that.
Justin, do you think it depends on what kind of DAO you are in terms of like just using stablecoins and equivalents as an example, like trying to understand, okay, what are the risks of, on chain versus off chain versus algorithmic, and then like as, X type of DAO that is in the following like product space or, the size of our DAO, like which types of these risks matter more or less? Do you think that matters, or just like any DAO should be sort of potentially diversifying across these stablecoin types?
I think most DAOs should probably be doing this. Like, for instance, collateralized, right? Like, there was a large scale regulatory action against those types of vehicles. It doesn't matter if you're a large DAO or a small DAO, like any DAO that's holding those types of stablecoin assets, can be affected by those types of regulation events. And then I would suggest too, like even with algorithmic stable, that's the ideal in crypto, right? Like we don't have to rely on a third custodian. You don't necessarily have to rely on different collateral asset types. Like algorithmic would be like the ideal solution, but accomplish it has a lot of like Ponzi-nomic features that occur. And yeah, it's the most risky as well. So I think it's very hard for a DAO to kind of decide between these things. And I think that matters like no matter what stage the DAO is at, right?
Word.
Staked ETH. So allocating to ETH itself, you can choose to allocate funds to ETH for a variety of reasons. So there's reducing portfolio volatility, since again, like it's less than perfect correlation to your own native, and lower counterparty and technical risk versus other potential reserve assets. Capital appreciation could occur with ETH versus like holding stablecoin reserves, which aren't going to appreciate in value. And then there's utility around holding ETH for operational payments, a reserve to help dampen budget variability. So like to clarify there, if you do have outflows are denominated in ETH, you might report it in your stablecoin operating currency for financial reporting, but you might still want to hold a reserve of ETH to account for those. Again, like that, it's like a price volatility matching to the operational expenses that. And then yeah, some protocols accrue revenue, so they might just naturally hold an allocation to ETH as well. For funds held in ETH, you can elect to keep it all or modify the risk return profile by allocating to stake derivatives. On the stake derivative side, like you're capturing yield from the network, it's considered lower risk than a lot of direct DeFi yield opportunities. But again, like you do have these different risk since you are usually staking with a specific provider, whether that's the individual or delegating your stake to or the platform that's issuing the derivative. Like there's still going to be like risks around like counterparty and market risk. I'm like you might recall like the stake depegging, which I don't think is a fair analysis. Like it's not technically a peg since it's not pegged. In fact, you would say like traditionally, like you would expect that asset to have a lower value relative to ETH. Like it shouldn't technically at parity. So like, but there is like, actually, liquidity concerns or whatever runs on those. You have a significantly larger discount than originally intended. So a market risk component to that as well. Then indices. So protocols, passive investment exposure asset classes within crypto. Passive investment vehicles kind of accomplish a couple different things, right? Like they reduce the amount of mind share the DAO has to have making investment decisions. Like rather than picking like, oh, we should invest in XYZ different tokens, like you can get broader access to a variety of certain subsector. And this is usually for like not when you're looking at like strategic investments, but just like broad scale. Likely isn't going to be taking a rather large DAO, but I think it's important. And these passive investment products building blocks to do automated rebalancing, right? They balance themselves, and then you can also set up using things like auto rebalance as well. And then in some places, like you can even use these in DeFi through different integrations. So like DPI with Pulse Index from Index Cloud that specifically DeFi subsector of crypto, that's available for lending and borrowing against on Aave. And so it's like portfolios of passively have substantially greater returns than actively managed. And like I said, notification, you don't want to drain like the DAO's attention span. Like if you're going to do broader scale efforts outside of just stablecoin, probably I would suggest considering like passive investment vehicles.
So, Justin, one question I have here is like, um, you mentioned on a previous slide that like risk assets in crypto often trade together or like highly correlated. How do you,
Yeah.
in the context of indices, like, what is an indice of like also crypto risk assets that correlate together really give you from a diversification perspective?
Yeah, so even though they are correlated, like to that point, like it's a risk asset, so you shouldn't
Like we're diversified now
because we hold all and we're like a social crypto DAO. Like it's kind of like naive. But the point of maybe doing these passive investment vehicles is on the flip side. So like during of like cap in the market, like different sectors have different return and risk profiles relative to each other. So they're like on like metaverse gaming style to off relative, right? And pairing those two assets together kind of creates this portfolio where you're seeing volatility in those while potentially capturing like an expected return that's better than holding ourselves. Because like you shouldn't be treating this as like, oh, we're safe now. DeFi tokens or tokens. Like the idea is that you are going to capture some additional capital appreciation by being invested in all these different areas, if that makes sense.
Yeah, that makes a lot of sense. So you're still going to be subject to the broader crypto market cycle within this element of diversification of indices, but you might be like less down bad. Like at certain times, right? Because
Right.
you're getting exposure to to all the different like subsectors of this crypto risk asset, which I think if we all, any of us that pay close attention to the markets know sometimes, sometimes those gaming tokens rip. Sometimes it's the dog coins, they don't all go at the same time.
Note again, like reserved for DAOs that significantly larger treasuries, and like this is like post financial stablecoin reserve. Maybe you've done some strategic investments as well. Like all of that's accounted for. Then it's like, okay, what additional diversification efforts could we potentially take of our cap? This is why I would probably recommend indices over, having a dedicated team running a hedge fund inside the DAO. Okay, and then like methods of diversification, right? There's swaps of native tokens, so that's the immediate way to raise stable coins, most detrimental to price. Market selling signifies to stakeholders a negative outlook, usually like, why are these people dumping on us kind of thing. There are ways potentially of diversifying outside of just doing like direct. There's conditional order strategies, so that's condition-based order invest tokens in the stable over time. That could be done like regularly on like a calendar-based rebalancing schedule, or doing like TWAP or VWAPs, limit, etc. There's DAO Treasury, so that's two different DAOs to mutually trade one another. If you're doing this type of strategy, I'd investing constraint DAOs that are in the deal, and then like plan around like how governance should be done both of those entities as well. You just want to make sure swaps with one another. Then there's OTC, so that's directly exchange without flowing to the secondary market. So it could be a deal with institutional investors, or a direct deal with even like community, which and at least direct impact on price, since it isn't flowing through any like liquidity systems. Is just like being done again like Um, Offers the additional flexibility with token lockups and vesting schedules. Um, there's derivatives, which I won't spend time on, but essentially, you can include creating a hedged collateralized debt position and then novel financial range token or implementing like management programs like automated rebalancing through things or income generating strategies like Ribbon's treasury vaults, like also diversifying out. And the most ideal, but probably the for some protocols is earning revenue in other tokens. You kind of naturally accrue diversification over time. Yeah, I won't spend too much.
So wanna just like ask like uh, a related question about this execution of diversification. So how do you think about like other forms of risk besides asset price volatility risk? So like we've talked about this with stablecoins and indices and stake ETH. Like there's basically risk of price depreciation or unexpected price depreciation, like depending on or even like legal risk depending on the asset. But I'm wondering more about like smart contract risk or maybe like lack of legal protection. So I think something we've seen in crypto is like, there's potential for large scale hacks, and also you don't really have some of the like downside protections that you might expect in TradFi. So like if you're sort of like running some sort of strategy with like a hedge fund or like using a trading desk to execute like a VWAP, and they just like lose all your money, like maybe you'll have some level of protection against that in TradFi. Whereas like if you've decided to use like a really weird AMM for your like swap, like a fork of Uniswap V2 on Phantom, and it gets like rugged, you're probably just it's probably just like over, right, for those funds. So like hopefully you're not doing that. But the point is like how do you think about these types of risks, like in the case, as you're considering treasury diversification?
Yeah, I guess smart contract the main ones to pay attention to. Like for instance, if you're doing a yield generating, like you might deposit into a certain protocol, then under the hood that protocol is routing that liquidity back to another protocol, and smart contract dependency, right? And when that's the case, like an exploit on any point of the smart contract chain there is going to have like ripple effects for the investment that you're making. So it's very important to consider smart contract dependencies when doing like yield generation and things like that. I'm personally not, going out and delegating like large scales of their treasury assets to a specific third-party custodian. Like I think the benefit of DAOs and crypto keep assets on chain where they're relatively transparent. Um, yeah, it's TBD what kind of legal implications are like interacting with a market maker. Are you acknowledging that value of the token that your DAO has be determined? Like there's a lot of these kind of legal regulatory questions that are super gray area. Don't have a lot of on DAOs themselves. I think should be relatively conservative, like different tools they're using, etc. If that makes sense.
For sure. Thanks for touching on that.
Yep. Cool. Dex swap side, I won't spend too much time here again, but like just quickly, there's traditional dexes like Uniswap or SushiSwap. There's dex aggregators like 1inch, and then there's like this meta dex aggregator class, like CowSwap. And I wanted to spend a second just on the CowSwap side. Like, if a DAO is going to route liquidity around or orders like a traditional dex, you're kind of limited to whatever the liquidity constraints on that specific DEX is. Like you want to, analyze across multiple DEXs, which DEX aggregators already kind of do for you, right? Like all these different DEXs and try to fill you at the best price. These meta DEX aggregators like CowSwap, I think more DAOs should be considering use of these because in CowSwap's trades are not only protected from things like MEV or sandwich attacks, things like that, but you're also getting like maximized liquidity because if CowSwap implement like a batch auction that has once it's called trading against someone else that wants the opposite of you, and so they directly route it to them. Their best price on a DEX aggregator or actually even better price in the case that incidents of want filled. And then, you can even get like gasless trading and things like that. Like there's a lot of benefits to using like aggregators like CowSwap over like just using a Uniswap. But I'd say at the very least, like consider a DEX. You want to be kind of trading at the best price available. If that makes sense.
How much like size is necessary for something like CowSwap, a meta DEX aggregator, to be relevant? Like I assume it, if your DAO is trying to change out like, $5,000 of their native token for USDC, maybe CowSwap won't really come into play. So like, yeah, what are the scenarios, size or otherwise, where CowSwap becomes increasingly important?
Yeah, I don't have like a direct. You're able to trade on something like CowSwap with small amounts too, just similar and things like that as well. Like if you're trading like your own native token against like a pair that you're incentivizing liquidity for on something like a Uniswap, like that's small scale amounts. But yeah, as you hit the nail, like as you go up in order size, it becomes increasingly more important to use some of these like MEV preventing tools because I see those as better opportunities to front run or sandwich. So I don't have like a direct number. It kind of depends on the amount of liquidity on the DEXs themselves, but as it goes up in size, definitely consider kind of transitioning over to something like a CowSwap.
All right, all right.
Yeah, DAO to DAO token swaps. So two DAOs swap a percentage of their token supply here with one another. Usually it's to rely on incentives and diversify each other's treasuries. Although, like we said earlier, it's kind of, iffy on the diversification side, but it does a bit, specifically around like idiosyncratic risks, particular to like one DAO. But again, like I already kind of touched on vesting schedule and establishing governance guidelines. Yeah, risk for risk asset swap though. So it smooths volatility, but still very risk on trade. A good example of this, Gitcoin and Radical swap. So they formed a public goods alliance between Radical and Gitcoin and swapped a percentage of each of their token supplies with one another. So Radical got 500,000 GTC and then Gitcoin the range of Radical, which was dependent on like the final grant rate. But both DAOs now have to hold these tokens for a minimum of 2 years, and then they set up meta governance with each other so that each community is kind of like participating and they're able to vote independently, but they collaborate that affects like public goods as a whole. So it's just like a really good example of like a strategic alignment between two different DAOs. We get some diversification benefits. We can participate more broadly in each other's governance. Like it's very synergistic. OTC side. So here, like you're doing a treasury diversification round, you might be doing it with either the community or a venture investor. For these, like I would just note, like make sure to design and scope the raise, like get buy-in from the DAO itself before going with investors. also like specify a target date you'd want to complete this raise by, just to kind of limit some of the ongoing mind share that occurs. Otherwise, like these raises can sometimes get stretched out over really long periods, and it's very distracting. Uh, like I said, like gather community consensus up front. That helps prevent issues like what happened with sushi during the sushi phantom troop strategic raise proposal, where there was a lot of pushback from the community as to why they needed to raise at that time and why those specific amounts. So getting like helps a ton. Deal sizing, like if a DAO sells too many tokens for too little capital, it damages longevity. I would say it should, and like it, from the investor side too, like it's not like a good like rug the DAO's treasury up front. So hopefully like incentives are relatively aligned on not taking too many treasury. And a would probably be raise that stablecoin buffer we were talking about earlier. Fund operational expense 1 to 2 year period. You usually do this OTC trading with an investor, or ideally multiple investors, just to kind of decentralization, but get that reserve this way. And like I mentioned earlier, the market has like the least impact on trading values at the time. Like it's one of the better ways, I think, diversifying outside set token on it. You're going to want to include vesting periods here. 1 to 2 years usually is kind of like what we see the most. Ideally, like the longer the better, because like they're strategically for the long term. You have to balance that, of course, with demand as well. Like right now is a difficult time to like the appetite, so make more attractive terms, which again alludes back to why you should raise stablecoins before we get into market environments like this. Yeah. Also, like, don't try to constantly. Volatility should be considered when you're initially pricing the deal. Like, if you have to keep like going back and forth, both sides to come to a conclusion. And then composition, like consider the biggest risks. Like if you have like consider strategic investors that might can help. As an example, if you need help on like community development side, choose an investor that kind of on that side. Like you want to do where the DAO has no risk. You can do that through a combination like institutionals, angels, investment DAOs, community investors. Like it doesn't get said enough directly for the community as well, like legal ramifications, aside, but like there's a variety of ways to get by a scale of different investors to kind of help that stablecoin reserve in the most responsible way possible.
Love it. Love it. I have a follow-up question about OTC deals. Do we find like, do you find that there's a difference? So there's quite a few DAOs out there where they have a token and they also have some kind of like equity that exists within like a legal entity that is very involved in the DAO. Do you find there's like a difference in kind of the level of interest? This is kind of a specific question, so you can just say you can punt on it, but there's a difference in the level of interest between in terms of like participating in these OTC deals from investors, in a token where it's just like the token is the only potential value accrual mechanism versus where there's also some sort of like potential cash flow going to illegal equity to like equity in the DAO.
That's a good question. I like my opinion solely. Like I think we're all here because we understand that token like value accrual to a token likely like exceeds value accrual to an equity-based company. Has been a protocols and DAOs uh, using like a centralized company with different, whether that's BD or liquidity bootstrap. Like those make sense in some instances. I just, in my opinion, like work itself, if you have a viable tokenomics model, like that should be able to justify value accrual. If you have two sets of investors, like an equity company, a token that don't accrue value, don't have the limit, what's going to happen is you're going to have two sets of investors, one wanting them to have and one wanting them to have go to the network, and not the most ideal sense. So you either need to make sure they're very incentive aligned if you have organizational, or shoot for one or the other. It's kind of a muddy, makes sense.
I love it.
Cool.
I love it. We're bullish tokens. That's like
Yeah,
a
yeah.
very, it's a very
Token
contrary.
maximalism.
Yeah, that's a very like contrarian take. In the bear market. But I'm right there with you.
Yeah. Cool. And buybacks, like more and more does explode when token prices are depressed like they are today. Buybacks just get some tokens off the secondary market. Like similar in traditional finance, buybacks, like they're considered an alternative to dividends. The good thing, signal to the community, or that the DAO itself thinks the tokens are undervalued relative to where they're. It's a negative signal. I don't think this gets talked about enough, but if you have any other positive net present value opportunities that the DAO could be taking with its resources, such as like R&D, or bootstrapping additional engineering resources, you should probably spending on those higher NPV opportunities versus just like repurchasing your token. You have a market environment, you might pump a ton of money into a repurchase that, it just gets like sold into. And now the DAO has less stable coins or less capital, more of it's, which is nice, but that's not way of going about things. So I always highly recommend look at these other opportunities first before kind of implementing a buyback. If you do a buyback, though, there's the standard one where you're just purchasing off the open market. There's buyback and burn, which is popularized by Maker, where you're using revenues to buy back the governance token and burn the supply. It works like a dividend. And then, yeah, buyback and make, which is linked there from placeholder. Yeah, I don't know, but I again just like echo strong. Try ways of, it's not just like nested in trying to get a token, if that makes sense.
Yeah, I'm gonna drop a hot take here as well.
Let's hear it.
I think the way that like you see some DAOs talking about buybacks falls into the category you just described, Justin, which is like either the DAO, there are certain people within the DAO or like the community just wants some kind of like short term pump.
Hmm.
Probably that they themselves are planning to sell into. And so I think like yeah, the context in which we talk about like people talk about quote unquote buybacks like historically in crypto probably doesn't make a lot of sense. I do think like buying back shares is a really important capital allocation option. But like I think there's probably opportunities for first of all like you know there's probably not a lot of DAOs that are like generating sort of sufficient like economic value to like really justify that. But for the ones that are, I think like having some sort of like buyback program that occurs on a consistent basis and is designed to sort of like minimize market impact and just sort of like slowly create a supply sink for the token over time is probably a lot more of like a reasonable approach than like what you see on Twitter of like, yeah, they're gonna buy back like this much of the tokens so that we can all dump into it. Cool.
Absolutely. Yeah. I should preface that. Like, I think like tokenomics models can inherently have like buyback built in, like what Maker does. Like, that's a very cool use of like a sustainable token. The issue with like what you just pointed to, like there's also the opportunity for like the Treasury working group we were talking about earlier to be like, oh yeah, we should do a buyback of X amount. And it's just like murky, like you don't necessarily know like if they're incentivized a certain way because like you said, they want to sell into it themselves. As more like less human involved buyback process, if you are going to do X, the better. Cool. Last section, just kind of on like earning yield. So again, like kind of thinking about like the structure of this, like first is financial reporting, then you're creating a stablecoin balance. The to get that stablecoin balance, diversification methods, and then once stablecoins, it often gets brought up, what do we do with them now? And yield generation is usually viewed as a solution to this. There's a lot of caveats here, but we'll go through those here in a second. But essentially, when you're generating yield, there's three types of underlying features that you need to be aware of. So there's the principal, so that's the capital you're at the very beginning of the investment period. So, for example, like depositing into Aave, that 1,000 USDC is the principal. Then there's the yield, which is the return you're earning, so earning 15% in USDC over 1 year. The 15% or the 1.5% APR there is the yield. And total return is the net gain or loss in the principal value plus the realized yield that you're doing. So earning yield on Treasury not necessary, but can be useful if you have a very low and your short-term needs are for sure met. Recommend maybe the 1 to 2 year runway that you're looking at be kept in non-yield generating because of that like smart contract. But say you have additional above that, like sure, like earning yield, revenue, that without like having to introduce like new products or services or whatever. Common ones I think we all kind of understand: yield farming, LPing, lending, CDPs, option writing, and fixed income products are the most common. Looking at principal, like it should be recognized like there's different types of principal. There's price stable principal, so that's where the principal token doesn't fluctuate in value, so that's your stable. Fluctuating principal, so that's where there's some kind of inherent price risk. That might be like holding ETH, for example. There's application. It broadly principal fluctuates in value and contains price risk similar to fluctuating, but it represents a project rating yield. So for example, like GMX, like stake tokens to receive cash flows from platform fees or inflationary rewards, like that's like an application token principle, and is kind of like a subset of price fluctuation. On the yield, there's token agnostic yields and token specific yields. So token agnostic is when a user gets to access a particular DeFi. So for example, like lending liquidity or counterparty liquidity. The main thing here is that the rate of yield is determined by demand and supply, and that it stems from users wanting access to the use case. Project agnostic yields are typically realized over events, so like transactions or epics, like access by being like a liquidity provider or holding a project token that has a claim to protocol cash flows. There's some examples of this. We don't have to go in there, but that's token agnostic, and then the fix, so that's where the yield is coming directly from the treasury. So this can be like token inflation, for example. And there's like no direct exchange in value that's occurring. So the like token specific yields are good for incentivizing like it could be like customer acquisition cost, right? Like you distribute X value in order to attract users to your call to whatever. Uh, there's that type of yield, and if you're on the other end of that, like if you're a DAO, the yields are um, the most sustainable. Like these agnostic yields are generated from some kind of real use case that's occurring, real revenues that are being flowed back to the user that's like staking or depositing into the platform, whereas the token specific is just like an arbitrary token inflation schedule that's kind of generating additional yield. Ideally, like I guess like best of both worlds is you have both of these in that. Important to consider the differences between the two. I don't know if you have questions there or anything. We'll pause for a second.
I don't have anything off the top. Monet Supply commented in the chat about buyback and burn that like in hindsight buybacks might not have been good as just retaining as good as retaining capital. Maybe pointing to like some of the challenges you highlighted on your slide with buybacks, even though MKR is probably like the MKR buyback and burn is probably a lot more of a like legitimate attempt at buybacks than we've seen in other cases. Maybe still not there are challenges to making it the most productive use of capital.
Right, right. And like I said earlier, like it's an innovative model, right? And like it showcases like the power of economic systems. But yeah, to his point, and like a lot of cases, like keeping that capital for other uses is probably ideal. But cool. Yeah. So like lending protocols, lending, so that's like depositing into something like Aave or Compound. Like we were talking about earlier, there's smart contract risk. So exploits or poorly deposits, just mint glitches, things that could go wrong on the smart contract side. So utilization of supply from borrowers, depositors might have to wait to withdraw funds. So you might not be able to get it in like a time sensitive manner if it comes down to it. And then there's always like the solvency risk. So if collateral value falls below the threshold, the required threshold, the lending will liquidate debt. And if the price falls too quickly, technically like the value may fall below the borrowed amount before liquidation takes place, which means depositors. So it's just like I would say in most cases, if you are going to do yield generation, something like an Aave or Compound probably makes the most sense as like a first step. It's not like stacked smart contract risk, so really you're just kind of relying on the smart contracts of Aave or the smart Compound. Their concerns, but yeah, it's a step up then maybe leveraged or depositing in a protocol that then deposits into Aave, like stacked risk then.
But what if there's 420% yield on an ohm fork on Avalanche?
Yeah,
Do I have to stick with Aave?
Yeah. So again, like going back to the yield, 420% yield, that's token inflation or yield as opposed to token agnostic. Sustainable. Or shouldn't be, I guess. But
Okay, just checking.
yeah. CDPs, so collateralized debt step strategy for yield. So you lend an asset on a lending protocol, you borrow a stablecoin. It can be a different risk token as well, but ideally it's stablecoins against that asset, and then you deploy those stablecoins into either back or even into like different yield generating activities. What you're essentially doing is making whatever that borrowable against generate yield. So like for instance, say like your native tokens on Aave, you might not have like other opportunities outside of depositing it into Aave and then to like generate yield on it. So you get like the supply yield, but then you also are able to stable coins against it and deploy those. So it's kind of like earning yield on the original deposit. It's though consider net interest relative to total risk. So you'll be paying both like a borrowing rate. You'll earn a lending rate against that, but and the additional rate on the stable coins, but it's kind of like qualify these things before like executing one of these strategies. Monitor it regularly. Rates can spike or lead to them over time. So you get here all of the passive lending risk, plus you get liquidation risk and the interest rate on the borrowing rate. So that yeah, it's like stacking additional risk to do a strategy like this. Stablecoin exchange protocol built on top of AMMs, allow users to deposit two or more assets into a pool. Biggest example of this is something like Curve or even just like basic Uniswap. The depositors end up with more of the least valuable asset when withdrawing. So that's when you're pairing like multiple assets. So say you're in like, like a 3 curve pool plus like one other like sketchy stable coin. Like if stable coin, when you withdraw from that pool, like you're going to end up with more of that. You can make adjustments. There's like different amounts that you might receive back. So just something to note there. And then there's contagion risk too of one of the assets in the pool depeg significantly, like I was just saying. And then all risks inherent in the tokens being used, so the market risk, smart contract risk. Again, kind of like stacked risk here. Yield aggregator side, so on top of the yield stack, yield generating strategies. So this might be like using a example. The pros is there's higher by moving assets between these protocols. They're doing like automatic reinvestment or compounding the incentive payments so that it kind of reduces mind share for the DAO Treasury manager. And then lower transaction costs because the gas expenses on all the depositors in that vault. Condo being dependency risks. There's typically on top of the strategy, which can be avoided as well if you did it yourself. Again, like all these considerations around how much attention you can pay to these things. Monet actually has this really good slide from one of the Tally reports on like these different types of strategies as well, which I think sums it up really well. Like at the base level, you have this and the risks associated with them. Look at something like compounded Aave, the AMM, and yield aggregator built on top of all those primitives together. So shout out actual has links to his research there as well. Fixed income. Yeah, fixed income's like area on the yield generation side. So it's relatively niche in DeFi still. Like not a lot of users do this yet. You could probably expect this to, maybe with different models coming out, like you could expect this to become a larger subset. Just when you look at traditional finance, income is a very large market relative to other asset classes. So here, fixed rate is like leveraging the yield on the fixed rate, even converting like instruments into like zero coupon bond like. Rephrase that, I guess. Yield tokenization tokenizes the yield over a contract maturity date, and then so this is like Pendle AP1. And then they're splitting the yield into like a yield token and then a principal token. So with that yield token, you could sell it off, for example. You could use principal token, selling it and buying additional yield tokens. Like weird fit you can build out of some of these protocols. again, like with any fixed income investment, if you have a fixed rate, like you're gonna have reinvestment risk. So every time you earn an interest payment, invest it back in a protocol. That reinvesting, has like interest rate fluctuations associated with it. So you're not like guaranteed that flat rate over per se. In itself, you could lock in a low rate. Like today, like DeFi low, you could lock in like a low rate for a long period of time, and then they subsequently move higher, and it's SOL that negative rate. Notional recently had this where users lend so much that yields actually go negative for depositors, trying to like disincentivize that lending. So you have to be aware of things like that, and then they're not as liquid. They have maturity dates. If they do have liquid derivatives built around them, they'll can like impact those prices. It's always smart contract risk and dependency. So I guess like to sum up, like I know that's a lot of information. Investing an opportunity to like here's the high level you need to know. Like smart contract risks, each smart contract risk alters the risk strategy. You should be considering like is the smart contract audited? How many dependencies are there available? You want to try to alleviate some of those concerns on the smart contract side. The longevity of the opportunity. So rather than chasing yields or like those token specific yields that are super high, like the 420%, like you should instead like buy strategies that are economically sustainable with established protocols. That's going to kind of help both the, which is the next topic, but you don't get wrecked trying to chase a yield on some, alt layer one. So yeah, mind share wise, like again, I genuinely believe that a DAO is probably its scarcest resource. And so any that's absorbing mind share from the DAO or its contributors via the governance process, like is not beneficial. Percent yield is not going to make up for you overwhelmed by investment decisions rather than focusing on like the core rate. The amount of mind share involved with an opportunity. Concentration, like you should spread across multiple productive opportunities where possible. Like sure that also like increases the chance that you hacker malicious event, but when that does occur, it's a smaller subset of the total capital base that you're deploying. How much would make the opportunity worth the risk if you're only going to be generating like $1,000 a year and you have to like put a large sum of money into this protocol? It's probably not worth the risk, right? And then consider like the opportunity or sorry, the which protocols the opportunity exposes the DAO to. Like risk and reward, protocol fees, insurance, gas costs, management costs, like all of that should be considered when looking at the return profile. Like sure, it might be 3%, but if you're spending, an equivalent or more on just trying to manage it or manage around it, like that's means you're getting a rate. It's not worth the investment then. And then leverage, like try not to use it in most cases. That kind of sums up that. So yeah, I know a ton of information. We can make these slide decks available. There's actually a in here, so feel free to check out some of those other slides as well. Questions either now or afterwards, like you can always reach out to me. Happy to help. Like I said, I worked in traditional finance, kind of in portfolio management, and then here with different DAOs like Index Co-op and kind of trying to address some of these problems with a variety of DAOs. So yeah, happy to always help out on those ends.
That was amazing. Thanks so much for putting this together, Justin. I think it's like really thorough. if you're a DAO, if you're like a delegate in a DAO, I think this sending this deck out to your DAO and saying, hey, like, how can we, work through, the financial like tracking and planning part of this and start exploring opportunities for DAO treasury management in a disciplined way where we understand the full menu of options and the trade-offs kind of aligned with each would be like a really important value add that you could bring to your DAO. So even if you're not the in charge of treasury management, really like utilizing this resource to like help your DAO think about it, and get the conversation going within the DAO, I think would be like a really valuable thing to do. So this is a great live session. We are gonna distribute the recorded version of this conversation via the DAO Talk podcast feed, via the Tally YouTube channel, and we'll send out the deck as well with the links on those resources and also via Twitter. So really appreciate your time, Justin. I think you're doing the Lord's work here. So thanks for everything you do.
Of course. Awesome. You guys have a good one.
Hell yeah. Thanks everyone for joining the chat, and we'll see you soon. Peace.